The Morgan Report with David Morgan.
David Morgan with you with the weekly perspective for the week ending 22 May 2020. Well, let me start off the stock market again. Another robust week in stocks basis the U.S. stock market. The S&P 500 is nearing the test of the 200-day moving average. The Dow Jones Industrials were testing the April high, and the NASDAQ was trading at a 3-month high. On top of that, the transportations are looking good, ex-airlines, which is dragging it down, but both trucking and the railroads, are looking rather strong basis that index, which foretells probably at least the anticipation of more transportation and this coming back online situation being good to very good basis what the indexes are showing. So this is the blog, which you get to from the morganreport.com and pull down the blog tab, or you can type in the morganreport.com/blog. Either way you'll get here. I want to point out that these icons appear at the top, which are kind of hard to see, but they do indicate our LinkedIn, Twitter, Facebook, all those social media are up here. So if you're interested in what we have to say on those platforms, or you want to actually, get on the Twitter feed or whatever, or LinkedIn or whatever, you can do it up there. And a lot of people miss it because the icons are so small. So I'll just take a look. I did an interview this week. There's a couple here that you can get. Also pointing out over here on the right, this Onex icon, where it's a good place to buy gold and silver, especially if you want to accumulate, but you can't make a one-time purchase. They also have IRAs. You might want to check it out. I've known them for well over a decade, and I've bought on a every other week basis for over a decade and never had any problems whatsoever. So moving over to the Twitter here, I just posted a couple things from others. This one I just posted an hour or so ago was from John Rubino, good friend, and he wrote an article about the gold-silver ratio as a useful indicator. It's a very quick read. I suggest you might take a look at it. And another one I posted earlier today was from David Stockman, and he talked about a massive stampede into real money as confidence in Keynesian economics drifts away. And of course, that one I just talked about, Adelaide Capital, did an interview with me, rather lengthy one. It was very enjoyable for me, and gotten some fairly good positives on most of it. So there is that. 570 employees at Tyson test positive for COVID-19. And I decided I should show some of these. So here's one that will make everyone that listens to these very happy. American billionaires got $434 billion richer during the pandemic. I'm sure everyone is thrilled to learn that. America's billionaires saw their fortunes soar, $434 billion during the lockdown between March and mid-May, according to a new report. Amazon's Jeff Bezos and Facebook's Mark Zuckerberg had the biggest gains. The billionaire class obviously is not panicking over the pandemic. Moving outside of the U.S., this is from Reuters. Coronavirus crushes Australia's dividends with banks leading the decline through Hong Kong. Australia made one of the deepest dividend cuts globally this year, with more than $6 billion deferred or canceled as companies conserve cash to ride out the coronavirus, turning foreign investors wary of the country's normally high-yielding firms. Touching on oil this week. This is from oilprice.com that I frequent every week. 33% of North Sea oil is now too expensive to extract. The oil price collapse will result in 1/3 of North Sea oil left untouched because it will be uneconomic to produce, a study from the University of Aberdeen showed on Wednesday. According to the study led by economics professor Alex Kemp from the University of Aberdeen, even if Brent crude prices were to trade at $45 a barrel, as much as 28% of the oil left in the North Sea would not be economical to extract. A site I haven't talked about a long time, a very good site I used to publish on there fairly often in my early days, safehaven.com. Is Bitcoin actually worth the energy it uses? When it comes to thinking about which economic sectors and industry niches that consume the most energy, cryptocurrencies may not immediately come to mind. But for some of these crypto companies, their energy and carbon footprints are not just considerable, they're massive. The most famous, of course, is Bitcoin, which has an annual energy footprint slightly larger than the entire nation of Switzerland. The company's current energy consumption can be tracked from there. Definitely worth the read for all of you Bitcoin folks, pro and con. I think everyone should be aware of, every aspect of any investment that you are in or contemplating getting in or getting out of. Well, a name associated with luxury, Rolls-Royce, to cut 9,000 jobs as the COVID-19 takes its toll on airlines. Some of you may not know, of course I do, having an aircraft background, that Rolls-Royce builds engines as well as luxury automobiles, and that's what this is referring to. Less demand in the aircraft industry, and it could be that way for a very long time. I want to pause here and start making some comments on my perspective. Number one, markets always go down faster than they go up. Number two, I think the price in the stock market is pricing a perfect comeback rather than what I think will be a less than perfect comeback, which means certainly, as all of you already know, that there are disruptions and there are restaurants that will never reopen. There are businesses that will be gone forever. There's some that will be just making it, and there are others that probably will thrive. The restaurant industry as a whole is going to suffer greatly because of the mandate in almost all jurisdictions to keep the social distancing situation alive and well, meaning, of course, you're going to have probably half the participation in a restaurant than what you would have under previous conditions. And whether or not that provides enough cash flow for these restaurateurs or not remains to be determined. My guess, of course, is common sense. In most cases, it will be marginal at best, and certainly cash flow will be substantially reduced from what it was prior to this situation. Well, I've looked at stocks. We've looked at oil, looked a little bit at Bitcoin, and I talked about Ford opening and closing 2 days later. So a little look at the retail side of the automobile business. New car registrations in Europe fall 76% in April as coronavirus lockdown hits sales. Each of the 27 European Union markets recorded double-digit declines in April, but Italy and Spain saw the biggest losses, with car registrations falling by 97.6 and 96.5 respectively. I think you can get a perspective on this yourself. I mean, it looks to me like we are moving toward a push toward electric vehicles. We're also looking at a push toward driverless cars. We're also looking at a push toward, why do you need a car? There's Uber, there's Lyft, there's these other services. And the idea about a computer-driven car is that it's a utility. So you really don't need a car. I mean, most cars sit there, I forget the number, I think it's like 95% of the time they're parked in a parking lot or parked in a garage. And like 5% of the time they're taking you to the grocery store to work. So think about it. I mean, if you drive your car from your home to your place of work, and that's sometimes an hour commute, sometimes longer, sometimes you're lucky it's only 15 minutes. Regardless, you're on the road, let's say an hour, you park it for like 8 or 9, you come back, you drive it for another hour. So you can do the math on it, but it's interesting to contemplate what could be the case if you were able to just say, hey, take me to work, and it just drops you off, and that same means of conveyance is used again and again and again all throughout the day. Well, one motor vehicle or one electric vehicle serving many as required rather than having something that you personally own. And I'm not pro or con on this. I'm just thinking out loud, but it is an interesting concept to think about. As things contract more and more, the use of things will be rethought, and sharing things, I think, will be much more coming to the fore than we have right now. I mean, for another really corny example would be housing development where there's like everyone has their own personal lawnmower. I mean, basically you could get one really super duper lawnmower for every 10 houses or something and just share it on the weekend or during the week or whatever. Not saying that's what's going to happen. What I'm just trying to imply here is that a lot of things that we take for granted now are going to be rethought in the new economy, in the reset, in the new normal, however you want to phrase it. A lot of things you might not think of right now will be something that you will be thinking of later on how to make best use of the resources that are available. So I want to focus a little bit on gold and silver today. So we're looking at the CFTC, and we're showing it's actually today's date up the top. But I want to talk about how much gold is available here according to them, and this is the 22nd. You can check me on that. But we were at a point where there was just like, I forget the exact number, 200, 300,000 ounces of gold. And now what are we looking at as of the 22nd of May, 2020? We are looking at 8.6 million ounces of gold in the COMEX in the registered category. And on the eligible, which is usually all long-term investors that are just warehousing or vaulting their gold in COMEX-approved warehouses or vaults for a combined total of the 8 and the 16 in the pledge for 25 million ounces. But that's a much larger number than it was not too long ago. And it begs the question, wow, that's a lot of gold that came into the warehouses rather quickly. And since I'm on it, this is, again, you can see the date up here, 5/22/2020. This is the amount of silver on the CMA depository list. And you can see this is what Brinks has and CNT, Coins and Things, Delaware Depository, HSBC, read down the list. And what you find here on silver is there's 91 million ounces of registered, eligible 219 million ounces, and then the combined total for 310 million ounces. It's a fairly significant number. You have been seeing some movement into the ETFs, some of it from here, some from other places, but there is being a demand on both gold and silver, as we all know. What's interesting is that you're not seeing it show up at the COMEX. In fact, gold is being poured into the COMEX, really. I mean, from where it was just several months ago, 6 months ago, if I think I'm correct, someone could correct me, I think it was around 300,000. I mean, it was really down there. I think I did a video for our members, and I forget the number, but I talked about how pathetically small it was. And now it's up to, the 8 million or 8.5 million I just showed you. And by the way, this is JP Morgan here. Registered, they only have 15 million ounces. Storing for others, they have 145 million. So the total JP Morgan is 160. Now that doesn't count what they have as custodians for the ETFs, which you could add on to if you wanted to. I wanted to point this out as well. This is a chart for Brinks. I think all people that are listening to me have a pretty good idea who that is. But this is an interesting chart of a business. And we know it's mainly a depository and transportation service for precious metals primarily. And if you look at this chart and go back to the beginning of the year 2020, you're seeing that the Brinks Stock was at about 95. And you can see where it is now at about 40. It's been as low as 35. Now, of course, some of that has to do with the stock market sell-off. But it, like everything else, has taken a toll. It hasn't recovered yet. So some of these companies are still, I think, going to be struggling. I'm not saying Brinks is going to struggle to come back. I mean, it's a pretty solid business. It's a pretty simple business, actually. But since some of the transportation systems have been curtailed, to put it in polite terms, you're going to see a while, I think, in time before things come back to full function. As I said earlier, a lot of things will not. So I'm going to conclude pretty much here. I will leave off as I usually do with there's nothing more powerful than the truth. And I just went back. Someone asked me about some of my appearances on TV. This is Fox Business. I was on their channel for a while gold was really hot. And this is way back when I was a little younger, and it's kind of blurry. Forgive me for that. I'm just going to play a very small part of it. But everyone was frantic about gold at $1,000 an ounce, and isn't that too high? And So I'll just show you a short clip. I basically said that gold is far from where it's going to go way back when this was filmed in 2010, 10 years ago.
Where the dollar once again becomes under pressure and gold makes a little bit of a rebound here in the short term?
Well, I'm just saying on an intermediate or short-term basis that 1,000 basis the U.S. dollar is going to hold. And it looks so far as if that's a true statement. There's a lot of talk about what's called the Chinese put, the insurance policy basically that the Chinese countries are willing to buy gold in the open market around the $1,000 U.S. price level. Now, no one can prove that to be true. The market has to prove that. But right now, we know that India bought 200 tons of gold recently in the open market through the IMF sale, and there's rumors that China wants to buy the rest. So I really think that we're going to have to wait and see to